All right, folks, so the Fed has given the first hints that they're going to cut rates next year. The dot plot officially, which the Fed always loves to tell us that the dot plot is not official. Well, the dot plot officially says that they are going to cut rates by 75 basis points, 3/4 of 1 percentage point next year. Currently, the Fed funds rate is at, they always put it a range of 5.25 to 5.5. So that means that the new range will be 4%, 4 to 4.25. Oh wait, what am I saying? No, it'll be 4.5. My gosh, I was giving them. Well, who knows? It'll be way below 4% soon enough anyway, because once the Fed starts to forecast that they're going to start cutting, once they actually cut, they're going to cut by a lot more, because if they're in a position where they need to cut, they need to do it quick. Slow cuts, nobody notices that. It has no effect. Just like way back in March of 2020 when the Fed cut from what was it, 2.25% all the way down to 0. That's what they're going to do again. And when the Fed gets around to finally cutting, guess what, folks? You don't want to own anything at that point because everything's going to be falling. That's why the Fed cuts. You know, you can argue all day you want about, oh, is it a chicken or an egg thing? At the end of the day, when the Fed's cutting rates, assets are cutting price. And so in all likelihood, things will be going down if the Fed is starting to cut. Or, who knows, maybe the Fed is just so desperate that they're going to cut rates even if things are fine and dandy and asset prices are on the rise. Maybe the Fed will just try and ride the high of rate cut optimism for as long as they can and not actually go forward with any cutting. Who knows? Because these people are always flying by the seat of their pants. They do not plan ahead. They're always just prodding around in the dark, trying to feel their way through. There is no grand master plan. The Fed are not, it's not a council of wise sages. These people don't know any more than you or I do, and they don't even think that they do. Which was actually kind of, that was, I think I've talked about it before on this channel, the time that I met a voting member on the Federal Reserve Board. I won't disclose who, because of course this was a private conversation. But that was the way it was explained to me, that they just kind of fly by the seat of their pants. They do one thing, they move very slowly and in small increments because they don't know what's going to happen. And if they do something that leads to positive results, they do more of that. And if they do something that leads to a negative result, well, they just reverse it at their next meeting, or they do less of that. So there's no real deep rhyme or reason. These are just, a bunch of people who are playing willy-nilly with the global economy. Might as well pick the first, how many people are even on the board? I don't know, let's just say 12. I think it's like somewhere around 12. Pick the first 12 people out of the phone book. You probably are going to have about the same results, if not better results. Now, in reality, has anything really changed in the Fed's statement? Well, a couple of words here and there. The Fed basically said that inflation is slowing. Okay. I'll give them that. We don't have double-digit inflation, at least according to their official rigged metrics. Shadow stats is always another matter altogether. Now, is the party over? No, not yet. In fact, the party could continue to go on, and the Fed could not change anything. There is always that option. I won't say that the end is nigh, because Lord knows I've been burned saying that in the past. But I'll say this: when the time comes that the Fed finally starts cutting, The opposite of what, for some reason, the media is expecting will occur. Historically, when the Fed's cutting rates, that's when things are getting bad. Again, we can argue the chicken or the egg thing all day long. At the end of the day, doesn't really matter. There's so many variables in the economy. It is fun from an academic perspective. This is what I love the most about studying economics, is the why. Okay, why do things occur? Let's try and explain these things logically. And that's important. It's important to have that foundation. But as far as the information that you need to know in order to set your expectations, what you need to know is that Fed rate cuts are correlated with bad economic times. The Fed cuts rates, ideally, in their mind. The way that their attitude works, what they're trying to do is cut interest rates when times are bad. They raise interest rates when times are good, and this is from their perspective. I don't think that these are necessarily good times. But when the Fed thinks the times are good, they raise rates so that they have room to cut them when times are bad. And so, when you're analyzing the Fed's behavior, you have to analyze it from their perspective. Now, stepping away from the Fed's line of thinking, just banking on common sense, when you look at interest rates and you look at the price of cars, the price of housing, just keeps going up and up and up, it's hard to square that circle. It's really hard to understand how anyone is buying a $400 or $400,000 shithole with a 7% mortgage rate. It's hard to understand how people are able to finance $150,000 cars, or $100,000 pickup trucks. Is everyone paying cash, really? Everyone's paying cash for their $150,000 sports car, for their $90,000 F-250. Some people are, sure. But most Americans can't do that. Most Americans have to borrow money, and they live paycheck to paycheck. And then you look at a place like Florida, where it's almost impossible to get homeowners insurance. They keep making it stricter and stricter, and they keep taking away people's insurance, which then gets them in trouble with their mortgage company, because if you have a mortgage, the lender wants to make sure that your house is insured because that's their potential asset. That is your collateral for your loan. And so if, let's say your house gets destroyed in a hurricane and it's not insured, the bank wants to make sure that they're going to get their money and that you're not just going to stop paying your mortgage, which makes sense. However, when you consider that the insurance companies now are moving to demand people replace their roofs every 10 years, whether they need a roof or not, and I'll give you folks a hint, you almost never need to replace a roof after 10 years. A roof is supposed to last you 15 to 30 years. 20 years, maybe, average. If you've got a metal or a tile roof, 30 years about what you're looking at. That's what you should expect. Shingle roof, 15 to 20. But the insurers, they want you to replace every 10 years. Oh, and also, you can't have any trees around your house. And when you do have your roof done, you have to have all this extra stuff put in. And there's all these things like this. And they look for every excuse they can to cancel people's homeowners insurance. And the rates are insanely high. You combine that with your 7% mortgage rate. How is anyone buying a house here? I don't get it. Maybe if you've got a 2-income household and you both make like $500,000, okay, then maybe you can live in like a normal neighborhood. But I've been saying this for a long time. I've been saying that I don't understand how these prices keep going up, who's paying for them, and yet they continue to do so. So this could go on for another decade. Based on what's happened so far, do I think that that's likely? No. But again, I don't see how it's gotten this out of hand as it is. Hopefully, we'll look back on this time 10 to 15 to 30 to 100 years from now and see it as an insane time when prices just seem to not matter and when everything was just unaffordable. Hopefully, that's how this time will be remembered, and things won't continue to get worse. Hopefully, they get better. And we'll look back and say, oh, gee, wasn't it bad back in 2023? When you had a 7% mortgage rate on a $350,000 house that was a 2-bedroom, 1-bath, and 800 square feet. And then we had to re-roof our house every 5 years to keep our homeowners insurance so that the bank wouldn't foreclose on us. Oh, and remember how the pickup truck I had to buy for my small business where I don't know, mow grass cost me $50,000 for a stripped down 2-wheel drive plain appliance white 2-door pickup truck, and I had to wait for like 8 months for it to be delivered. Hopefully this will all just be a bad dream. But that doesn't seem to be the case. The only time when prices ever seem to have gone down in modern American history was the period between like 2006 and 2012. Other than that, the price of everything just seems to go up and up and up and up. Oh, except for, of course, the housing market in the 20th century, which never went up at all. So yeah, there's a lot to be pessimistic about. There's a lot to be uneasy about. I could not imagine any greater period of uncertainty than what we are entering now going into 2024. I do not know what the economy looks like in November of 2024 when we go to vote. Things could be very, very bad, or things could be just as bad as they are now. So with that said, I will see you folks back here tomorrow.